Let's talk a little bit about last year. So what we had first was this vaccination deployment, if you want to call it that. This, just visually, is the United States, and that's the percentage of people, it's hard to see, the dark is fully vaccinated, and combination is partially vaccinated, means they've had at least one, right? So at the end of the year, the United States had 73%. Now, my best friend moved home from United Arab Emirates, which was number one, because his family couldn't handle it. They wouldn't let him out but 1 hour a day outside. But they have 99% vaccination rate in UAE. So I just think this is a kind of a good idea to think about how much we've really done across the globe and why this did allow the globe to open up economically. There's some interesting ones there. That number 2, if you can't see it, is Cuba. So I guess the way to get people vaccinated is to control their lives, 100%. Let's talk a little bit about activity. So this was interesting. People were returning to restaurants and stores, cafes, museums, amusement parks, things like that. Thinking about this, though, when the Delta came out, it slowed it down, as you can kind of see here, right? So we were nice moving along, and then the summer hit, right, and then Delta, and then we came back, and at the very end of the year, you can see a drop-off, right, from this latest variant. And to give you an idea, December 23rd, France's recreational retail activity was growing at 7%, a positive. And from then to the end of the year, it was negative 18% of the population. So US was positive 3 to almost negative 18. So just a drastic drop-off very quickly because of the last variant, which is not great starting into a new economic year. However, what you might not know is that we were already growing above pre-pandemic levels in the United States. So when I say we had a good economy, you can see third quarter 2.3, but 6.4, 6.7, and 6.1 estimated. It's fully not out yet for the number, but this would be an annualized number. So over 6% GDP growth in 2021, which is phenomenal. Probably why we started talking about inflation. Delta slowed it first. If Delta hadn't happened, right, the third quarter would have been robust, but that really happened starting about 4th of July. And then that hit us. It did ease up quickly, but it was a deadly variant. And then the latest one is not proving as deadly, but it's affecting more and more people. And so there's a lot of discussion right now from the economic world, not from the medical world, I'm not going to speak to that hopefully by March we will be back moving forward and we won't have as much COVID, at least this variant, to worry about. So we will see if that comes true. I hope it certainly does. Employment. Unemployment shock that happened when everything shut down. We saw the support from governments, not just ours, but all governments. There was a lot of money that went out to fund unemployment when people weren't working. Just to give you an overall idea, though, in November, we were back to 4.2% unemployment. 3 to 5% is full employment. So we were at full employment in November. So when people think about it and you hear about that, I just want to mention a couple of things about that, though. If you look, overall 4.2, men, women, about the same. Whites, 3.7, blacks, 6.7, Hispanics, 5.2, teens, 11.2. So it's definitely affecting different populations in different ways, and they still have unemployment in certain areas of the population. And particularly, as you would guess, certain industries are getting hit harder by the lasting COVID effects. But thinking of this, 23% of the group looking for work for 52 weeks or more was black. 61.8% labor force participation. 3.6 million American workers are saying they're not working because of COVID. So there's still an issue out there as far as people wanting to work. I mean, essentially, I don't know that all 3.6 million are going to go back to work if COVID was not here. It is going to be someone's convenient excuse. But a lot of those people would go back to work, particularly those that are physically jeopardized in one way or another. There are people, for example, talking to someone who had really bad asthma, And their job was with people all the time, and this person is petrified to go back to that job. So they need to retool if they want to do something different. But interestingly enough, what COVID did is just exasperate the number, right? So what was going on before COVID was that we had a labor shortage, particularly in skilled labor. And so we're still facing that. So although we talk about full employment, where employment is and where the population can serve are not a match yet. So this is the CEO of Jobs for the Future, and she reports, even before the pandemic, we faced an endemic shortage of workers to fill in-demand middle-skill jobs, which require education beyond high school, but not a full college degree. So to think about this, such jobs as electricians, plumbers, account for, and I didn't realize this, 52% of the U.S. labor market. But just 43% of the nation's workers are presently trained to do them. So it's an interesting statistic on the employment side. So this is still an area that we need to watch. Jobs drive the economy. And so it's a real gap that we need to fill. COVID isn't the excuse here, though, right? This is retooling American workers. When you have labor issues, those people who are getting jobs want more money, right? You have to pay more to attract more. And I hear this a lot. Last night we had a conversation. People working from home, for example, they were sent home. They like working from home. Well, now they want, wait a second, my company isn't paying for my internet and my electricity, but that company is. So I'm going to jump ship so that they'll start paying me for my internet connections and all of this kind of stuff. We've heard companies, just even remote workers, buying furniture and giving them stipends to work from home. So the competition is out there even for people who've never set foot in the office of the company they work for. It's pretty interesting. And of course, the other thing about remote work, which is really interesting, is that you can live in beautiful Wilmington and have that New York job with that New York income, which is a really interesting for our town, because we are in a lifestyle-based community, right? People want to be here because we're between a river and the beach. You know, we got great climate. I know it might not feel like it this last 2 weeks, but relatively speaking, it's still great climate. And so we want to think about this labor market, and it's a really interesting part of it. Now, for those of you who have been clients for a long time, I started talking about inflation in 2005 in regards to wage pressure. And I went back and I looked through other ones. Every presentation I gave between 2009 and 2012, I said, you don't have to worry about inflation until we see wage pressure. And I've said it miscellaneous since then, but every single presentation in that 4 years, because after 2008, 2009, government increased the national debt, and everybody said the money supply's out there, we're going to flood the market, it's going to cause rampant inflation. And I said, nope, it's not going to do that. But I'm here to say now, this is the first time in, pretty much my career, 23 years, that we've had this look of increasing wage pressure coming. So I would say that that's a real sign of inflation. Now, I'm not here to give you gloom and doom. That's not what I'm saying. But inflation isn't necessarily a terrible thing. You know, I think that people want to get paid more in 20 years than they do today. Right? So, and you know, if you've got some kids, grandkids, or people who are starting out in the workforce now, sometimes you're shocked at how much they make at their first job. Right? But that's inflation, and that's a good thing. That keeps our economy growing. We just don't want it to get out of line. So, some numbers here which are interesting. The average hourly earnings across industries, this is November stats, was $31.03. That's the average wage in America. So the bubbles are different industries. So the pink one was a bigger one. That's the amount of people. They are education, health services. They gained 4,000 workers in November, and the average pay was $30.49. Green bubble to the right, which is the bigger one, that was the manufacturing area. They were paid $30.15 an hour, and they added 12,000. And then the blue one down here, or the bottom left, that was retail. Average hourly was 22, and the industry lost 15,000 jobs. So you still see some of the trends that are out there. But I think manufacturing increasing, that's a good sign. Again, skilled is certainly what we need. Higher earnings have been affected by inflation, right? And I could say, well, it's one way or the other. Right? This could be the chicken or the egg. Right? Is it the hourly wages that are affecting us, and that's why we have inflation, and vice versa? And so I'll give the short version of this, right? So if it costs more to have an employee because they demand more wages, then we increase the price of our goods and services so that we can afford the employee, or we take a hit to our profits. Right? If our customers will support an increase, then we try to pass it out to the customers. So then customers feel the effects of the worker who wanted a pay raise. And so it's this cycle, right? And as long as it's in line, we're okay. When it gets out of whack and it becomes too much, that imbalance is where we feel the pain of inflation and wages. So it's something we need to watch, but it can be done in a very smooth and nice way if it doesn't happen too fast. And it certainly is going to flip industries and things like that with technology and innovation and things like that. Again, one thing I mentioned last year, and I'll say again, if you remember, wages increased drastically during COVID, but it was statistically because all the lowest wage people lost their jobs. So you take all the people who work in retail and hospitality and restaurants, and you put them over here with no work, and then you look at who's left, well, the wages went up. Right? You saw that starting to drop drastically as people went back to work in those sectors. So there's still some of that going on as well, too. So how much of that is part of the inflation equation? And I can't tell you exactly what that is, but it's part of it. Supply chain. Part of the supply chain issues were caused by not having workers. Right? That's certainly a part of that. And that is getting better, but just to give you an idea, everything from cars to furniture to golf and tennis balls, you couldn't get anything, right? Now you can hang onto a car a lot longer than you can hang onto a golf ball if you play with me. But it's been interesting, and you've seen price increases because of it, right? So are they taking advantage of us, or is that what needs to happen because it takes more cost to get that good to us? So there's a couple different issues at work. But we are seeing the supply chain subside, which is nice, or supply chain disruption subside a bit. So, and you can see it, they started to ease. Worldwide supplier delays moderated in November, thanks in part to reviving production in Asia after the Delta wave disrupted factories then. So there was a backup because of Delta, right when we started having some forward progress, but that has eased again. We're going to see what happens now. The data for this particular variant is still out. And so the longer this goes and the more issues we face, the higher chance of inflation being sticky. So it's something that we need to continue to monitor. And speaking of inflation, what we've got here and the dark shaded lines, there's two, it's hard to see, but the Federal Reserve's 2% target, here what you see is a personal consumption expenditures, which is PCE. That's what the Fed likes the most. It's core, and it takes out food and energy. And why does it take out food and energy? It takes out food and energy because they bounce around like crazy, and it would just mess up the numbers. So they take food and energy out to see, and they call that the core. So just so you know what I'm talking about there. So we complain about gas prices and groceries, right? That's what we complain about. But they actually take that out when they talk about inflation on the Fed level. So when you think about that, the lighter turquoise bar is that measure. And you can see the difference there. The light blue is a little steadier, and that's why you see two lines there. But the Fed's job is to provide a safe and stable monetary policy. And they're doing that by promoting full employment and fighting inflation. That's pretty much their two mandates. So everybody says, oh no, the stock market's down, I wonder what the Fed's going to do. The Fed actually is going to be talking about what they're going to do today, which is the market is going to be watching that. But inflation has been really low. And then you can see the last 2 quarters at the end there. It just looks drastically different. And that's from 2010 till now. So we really haven't had that much inflation. And we haven't had the inflation like we have right now. So it's something to be mindful of, but that's really only 2 quarters. So I want to talk a little bit about the policy change that the Fed made. So they had this flexible average inflation targeting. I mentioned it once before, but if you hear, they changed the way they measure inflation. I think they've done it 20 times in the last 25 years. So that's also a difficult part. But this is the first time that they didn't just change the formula from the parts inside the formula. This time they changed the whole formula. And so what they're doing now is they're taking a longer average and not changing policy until the average changes, right? So if you have one quarter, so they're trying to level out and make sure that this is real longer term inflation. And so what that is causing right now is people to feel like maybe they're going to get it right because they're doing it slower. And other people said, no, they're going to let it get out of control before they react to it. So that's sort of the debate here. And so this is someone from Goldman Sachs, the chief economist there. Although inflationary pressures are unlikely to subside quickly, I remain confident in the basic view that both headline and core inflation will fall significantly in 22. The Fed's delayed and slow reaction to inflationary pressures has unfortunately increased the probability that it will have to slam on the brakes by raising rates very quickly after tapering and at a more aggressive pace than it would have if it had started tightening policy earlier. And that's Mohammed El-Arian, he's actually works for Cambridge but used to run PIMCO, which is the biggest bond shop in the world. Fixed income investors stay on inflation all the time, and he ran the biggest bond shop in the world. Again, another prominent figure in the interest rate environment. So this is the biggest issue I think that we face with inflation. Is the Fed going to get it right? And we're going to hear more about it today. Last year, at the end of the year, the last meeting, they removed the word transitory. And removing that word startled everybody in the markets. And if you paid attention at all, when the Fed changes a word, everybody goes nuts. And so I don't know if they're going to get it right or not, but I can tell you, like, in 5 years from now, I'll be able to tell you. Besides inflation, which I'll talk a little bit more in a bit, we also have consumer sentiment. And so when you think about inflation, how does that change the way we feel? And consumers drive our economy. So you can see this, interesting enough, consumer sentiment was improving between November and December. And then, as I showed earlier, Omicron variant hit and sort of changed things. And so, they took that transitory word out, and we're going to see how that's impacting, because we don't have the January data yet, but it's going to not be as nice as this is showing us here. Let's turn from the economy to the financial markets now and talk a little bit more specifically about the stock market and stuff. Supply shortages push the inflation higher, hurt consumers. US, China, Japan, India, South Korea, and the UK all released strategic oil reserves. Did you know that? So that's one of the things you worry about, is that oil is going to cause inflation. They all pushed out oil reserves. But someone else pushed out reserves. This is the Quebec maple syrup producers. And Canada, for the first time in 3 years, tapped into their strategic maple syrup reserves. The so-called OPEC of maple syrup, they released there were 22 metric kilograms from its emergency fund, nearly half the total in the reserve. High demand and low supply due to a limited harvest had constrained supplies. So be mindful of syrup producers. I just want to watch out for inflation in your syrup. All right, so really the stock market did have some great results last year. 28.7 was what the S&P did. Some areas that were interesting, though, the inflation fear at the end really drove the interest rates up at the end of the year and then pushed the bond market down. So last year, bonds were actually negative for the year. Small caps did not perform as well as large caps. There was a recovery issue, so the Russell 2000s are smaller companies. And the concept there is bigger companies were doing better because they had capital. Smaller companies are still more subject to shorter term issues like the supply chain and things like that. And I always like the example of if you make a washing machine and you're GE, well, you get your screws from this one company that's in, who knows, maybe Bergall or something, right? So if that company loses the GE contract, they are pretty much shut down. GE just waits a little bit before they build back inventory. So the impact of small companies on these different issues is highly volatile. And so that's why last year you didn't see quite the recovery as you did. And of course also the S&P 500 is full of the big tech names that did start to lull at the beginning of the year, but then came roaring back with Delta, right? So everybody's like, oh, back to the technology wave because we can't go out and do anything. We think about the international market, and that actually was positive for the year. And with the inflation scare you see at the bottom here, 27% for the commodity index, right? So commodities went up in anticipation of the inflation as well too. Energy was the top performer last year in the sectors go. So although I talked about the technology boom, energy was the biggest performer. Now, it was the worst performer the year before. So that's part of this as well, as you've got to look at both of them. Whereas real estate, another area, recovered nicely last year. It was a recovery year. So it got hit the year before and came back strong. Technology is the yellow here. That's had 4 straight wonderful years, with the last 2 being really astronomical. Utilities, the worst performer last year. Why? Because those are considered defensive. And last year wasn't a defensive year. We didn't care about, our water and our power bill and those kind of things. What we cared about was, let's take some technology, real estate, energy, some higher volatile areas and try to take some risk on. And that's what we saw last year. I think this is more important than looking back on the performance of the stock, is look at the performance of the company's profit and loss statement. And 45.1%, despite all the supply chain issues, labor shortages, wage increases, all of that stuff, corporate earnings were absolutely exceptional last year. Now, it is growth from the pandemic. So just like I talked about energy, companies lost a lot of earnings during the 2020 COVID collapse, really for 2 quarters solid. So it's going to look good because these numbers are coming back strong. But just to give you an idea, they are overall, analysts expect growth rates this year of 9.6%. So far from 45%, but that's still good results. And so we still expect a very positive year in earnings growth. And right now we're in earnings season. So we are getting our 4th quarter earnings right now. And so over the next 2 weeks, we'll pretty much see how corporate America is doing. And I was talking to the team about this. Companies beat expectations 75% of the time in an average quarter. Now, I don't know how you guys feel about this, but I always feel like 50% should be the average. So I'm curious just how that companies 75% of the time beat earnings expectations. So either the analysts are all wrong, or the companies are all keeping information so they can look good at the end. I don't know the answer to that, but the bar is set at 75. So if it comes in at 65, the market's going to react negatively. So it's kind of a weird thing to consider there. So 65% of companies can beat earnings and the market won't like it, is another way of saying that. That just seems a little odd. I'll give you some ideas on some of this. So investors have not needed to care about bloated companies until now. So this is an interesting perspective on things. So this guy from Deutsche Bank, he says, they haven't needed to worry about this. Indeed, the S&P 500, average S&P 500 company earned $1 in sales for every $1 that it held in assets. But now it earns 60 cents on the dollar. So the focus on asset efficiency, in other words, what can we do with the assets that we have to generate earnings, is going to become more important going forward because profit margins and leverage are both going to come under significant pressure. And the reason that's going to happen is because of interest rates. So if you raise the interest rates, then leverage, which is basically borrowing to fund operations, your borrowing costs go up. So as a company, you can't grow as fast because it costs too much to grow as fast. The other side is the profit margin. Well, interest rates are going up because of wage pressure I mentioned. So if costs are going up, then your profit margin's going down if you can't pass that out to your customers. So if those are the 3 levers, what are you doing with the stuff that you have to generate income? what are you doing with your expense, and what are you doing on borrowing money to expand? If you take two of those away, it does put companies under more pressure. And I think that's some of what you're going to see this year. Again, how bad? To be determined. This is a valuation chart, so you've heard me talk about price to earnings ratios before. Shiller's one that this Cape one is a 10-year PE. Now, generally speaking, he always seems to say the market's more expensive than everybody else. But I thought this was interesting. He recently explained to the New York Times that examined on their own, stock valuations are at giddy levels. Yet, they are far from more attractive when viewed side by side with bonds. That's why it's so hard to determine whether the stock market is dangerously high or a relative bargain. So this is someone who always talks about how expensive the market is, and here he comes out and says, might not be as expensive as my numbers look. That's pretty interesting. Now, the question is there a better and safer place to earn money if you get out of the stocks? And so a couple of things, this was based on data that's now 3-4 weeks old. So to give you a concept here, the S&P 500, when I woke up this morning, was down 8.5% for the year. So stocks are already cheaper than they were at the beginning of the year. So here's some big names, which are also all in the top 10 biggest companies in the world by market cap. Microsoft down 14, Google down 12, Facebook down 11, Amazon down 16, and Apple down 10. The large growth, which is all the big tech names out there, that index is down 14.5%. So when you think about what's going down, is that the names that you think of that, oh, wow, I don't want to own any of that stuff for the next 5 years? No. You probably think, I don't know how many of you are waiting on stuff from Amazon right now, or Whole Foods from Amazon, right? So it's just really interesting. Now, the value side, which is our blue chips, that index is only down 2.5% for the year. And to give you the two top names in that index, which are also in the S&P 500 top 10, are J&J and Berkshire. J&J is only down 2, and Berkshire's up 2.5. So just to give you an idea of kind of where we are, the growth sector has really been hit hard. And the NASDAQ got to almost a 20% drop this year, which is a market crash. So we passed correction territory and almost hit a crash in the tech stocks. So I just wanted to mention that because when I'm saying all this about valuation, there are things that are a lot cheaper than they were already. Another issue that I think we've got to be mindful of is China. So China has been a growth engine for the world. And they were growing at times in double-digit growth rates. And then I remember saying, look, the rest of the world's growing at 2 to 3, and they're growing at 6 to 7. But guess what? They're not anymore. So there's a lot of fundamental changes in there, but one of those things is slower growth. And a lot of that's coming from what they're doing within their country. I don't know if anybody can see it, but the regulatory enforcement side is pretty interesting. I'll kind of talk about some of it. But the president of China is doing a lot of different things, but I'll give you a couple of the ideas that he's doing. He initiated all this regulatory stuff in the country, and it erased more than $1 trillion worth of stock market value in just a couple months with the regulatory action that they put in place. So it hit everything from online education and tutoring companies, ride sharing, delivery companies, social media companies, real estate companies. Those are all areas in which they applied regulatory restrictions on all these companies. And so it destroyed a lot of the value. They also, because of this, the U.S. said, we want to see the books. Show us your accounting. And so Chinese firms just started delisting and dropping off of our stock exchanges. So that's an interesting thing that's going on as well, too. So I think that's going to continue for a while. And so it's going to be a drag on global economy, but it also does impact the U.S. markets because these stocks are listed on U.S. stock exchanges. So some 1.5 trillion of Chinese company shares trade in New York. Those listings have already been threatened by American regulations that require all listed companies to provide access to internal auditing documents or face eventual delisting. Chinese officials have refused to allow access, often deeming this material as state secrets. Until now, no Chinese enforcement body has sought to control Chinese listings in foreign markets. So it's going to be really interesting whether this happens or not, but it could have a negative impact to our markets as well. Now, besides China, we're also looking at bonds, and bonds are down 1.83% for the year. Now, they had a 1.5% drop last year, so we're over 3% drop in the last year. And bonds are the safe money, right? That's what we've always been taught. They're the safe money. To kind of give you an idea, though, again, the stock market's already down. The worst year since 1999 for bonds happened in 2021. So you just went through the worst bond market since 1999. It probably didn't feel that way, right? Because your stocks helped you out. 3 weeks ago, the worst week on record for long-term bonds, negative 9.3 for long-term bonds in 1 week. Now, ready for this? The 10-year during that same week was negative 4.2 for a week. There's only been 1 week ever worse than that. February 1980, when the Fed was raising rates to hit 20% on the 10-year. So just to kind of put that in perspective, people are so worried about inflation and interest rates that they traded bonds like it's 1980. Right? It just doesn't feel that way. And so we're already seeing the bond market correct from that. And so I just think it's an interesting one because it's still downside protection. There are alternatives. Preferred stock, real estate, core plus are basically not just safe bonds, but some riskier bonds, some different kinds of things. So there are other options to try to pursue income out there. But they're not going to necessarily take away risk. They're going to take away maybe some of the interest rate risk, but they're not necessarily going to be safer for your portfolio. Now, I'm not saying that we don't look in these areas and shop in these areas because they're important, but the downside of the bond market is always going to be drastically different than the downside of the stock market. So when you hear about inflation and interest rates, I think the bond market will be choppy this year, but you're not going to lose value like you can in the stock market. So just to kind of keep that in perspective, you're going to hear about interest rates, you're going to hear about bonds, and that's going to continue. Here's the deal. At the end of an interest rate cycle of rising rates, our safe money pays us more. Money markets, CDs, muni bonds, everything is going to pay us more after rates go up. So it's only the journey to get there that we don't like, because we'd all like to get paid more on safe money. And so it's an interesting dilemma that we're in. We want to get there, we just don't want to go for the ride. And what I've said before is you don't want to jump out of the airplane just because there's some turbulence. That's going to end up worse for you. So, again, we don't want to go running from stocks because of that. Some divergent sentiment. So this is always a good one. So this is it's Association of Individual Investors, so non-professionals. And this was the end of the year. 38% bullish, 32% neutral, and 30% bearish. And so what's interesting about that is a lot of people feel like this is a contrarian sign. If the average investor feels bullish, right? Probably means the stock market's going down. It's already happened. So we didn't even get a month in, and it did. It was a contrarian side. So that's kind of interesting as well. And then the other side of that is that when it turns bearish, it usually is a great time to buy. So in other words, we could try to figure it out, but individual investors are always probably going to act out of the emotion in the news that we know we shouldn't be watching. Right? We all talk about the media, but then we all watch the media for all the information that affects our emotions, and then we make emotional decisions on what the media's telling us. So let's talk a little bit about where we're going. So I'll start off by saying Vanguard put out their 2022 outlook. And what it states was investors will get half the returns that they've had over the last 10 years. Half. Interesting. But in 2011, they said the stock market would do 7.5% over the next 10 years, and it averaged 16.8. I want to mention that because everybody's got opinions, and I'm going to go through some opinions from different things. We are a believer in the tried and true boring, let investments stay boring, right? Don't try to make them too sexy because you're going to mess up. So there's nothing wrong with, well, let me say it a different way. The markets are exciting enough when you take a boring approach, right? And so we've watched the cycle of stocks over the last 2 years. Some of the meme stocks that made a lot of money right after COVID, some of those are down 80, 90% since then, in a market that I just said how wonderful the stock market is. So I want to give you that, but there's really interesting that there's a lot of nice things going on out there. So I wanted to highlight a couple random acts of kindness that we found. So I love this. Social media site asked people to share their wholesome secrets, and they did. One person wrote, "When I was a kid, I used to always twist the quarter machines when I walked into stores." You know what I mean? That little gumball or toys or whatever. So and he got lucky a couple times and got a few free toys. Now that I'm grown, whenever I leave a store that has them, I like to drop change in them and just slightly turn them, so that when a kid walks through and goes and grabs it, they get a little treat. Isn't that a cool idea? I don't know if all the parents appreciate that. Another one I found that was really cool on the list was, I put change in people's parking meters so they don't run out of time. And I think you probably all heard of that before as well, but I thought that was always a really cool one. Another one as well, this is really sweet. And I know there's a little boy in my child's class that lives a hard life. So whenever the school puts on a raffle, I buy the kid a bunch of tickets and put his name on them. He's won a pizza party and an ice cream party this year. Isn't that cool? And I've talked about happiness research in the past, but that's still one of the most powerful things that we can do. And I would encourage that for 2022, right? That's something we can control. I want to talk about some other things that are interesting. Speaking of random act of kindness, there's this concept of ESG investing that's becoming more and more popular. And I've talked about it before, and I think it's going to continue. There's a lot of different buzz names for it. ESG, which is environmental, social, and governance, is the type of terminology that it's being settled on right now. I would say in 5 to 10 years, it's all going to be called ESG, because that encompasses a lot of this stuff. But you may have heard it called responsible investing, sustainable investing, socially responsible investing, impact investing. So there's a lot of different things. So some of it is gimmicky and Wall Street, and it drives me nuts. You can find a new ETF that is out there that basically is an index fund that gives money to the NAACP, right? But they charge more money than buying the S&P 500 index and writing a check to the NAACP, right? And so it makes me mad. It's like you look under the hood and see that these things. There was one that focuses on women-owned businesses. And that concept is that women-owned businesses are going to do better, and they're going to invest that way. It's formula-driven. There is absolutely no valuation criteria. It's if a woman is at the helm of your company, you get put in the index. So it could be terrible or it could be great. There's nobody looking under the hood to say whether that's a good company or not. So again, I think some of this stuff is gimmicky. People are trying to make money, and you got to watch out for that. But let's talk a little bit about the reality of this, is that 92% of the S&P 500 companies put out a report on an ESG report to talk about what they're doing in these areas. And this is important because actually companies in the S&P 500 that have women on their boards and women on their executive team have actually outperformed over the last 10 years, right? So there is some merit to this, right? There's merit to diversity in corporate executive team. There is proof that you can make some money doing this. There's proof that if you try to save money by being good to your people and good to the environment, that you actually can run a better business. So there's a lot of merit to this, and we're starting to see it. It's hard to label everything in certain ways. So for example, we used to do it by saying, I don't want any guns, alcohol, tobacco. So now I'm going to, this is socially responsible investing. I had one client one time ask me, I will take any investment out there except for a French company. When you need dang French companies in my portfolio. I don't know if that means ESG, but The idea here is that, and this is why people feel this way, to align their investment strategies with the organizational values, to influence corporate behavior. Right? We're only going to buy from companies that are doing the right thing for the world. To minimize headline risk. In other words, if we buy companies that are doing the right stuff, I don't have to worry about the company blowing up because they're doing the wrong stuff. I think here locally, right, Gen X. That's one that hit the headlines for us, but it hit them nationally. To generate higher risk-adjusted returns over the long run, conceptually, that we're going to save money by being better stewards of the environment, and we're going to find cost-cutting ways to do these things, save on our water bill, things like that. And then finally, I want to invest this way because I think it's going to help make the world a better place. There aren't a lot of options out there, but this is going to continue to grow, and I just wanted to highlight that. It's something that the ratings companies, as we're analyzing, we're going to start seeing more and more of this. So it will be something that we'll be able to integrate more and more as there are more options out there. 3.9% is what the CEO Roundtable thinks about GDP for 2022. That's a pretty good number. And that slide on the side, this bar is 3.99%, and this goes back again 10 years to show you what GDP was each quarter. Now, that big down one was obviously, that was COVID. And you could see 3 quarters later we were skyrocketing. We did slow down, but reality is we're still growing well above everything, and those are those 6.4, 6.1 numbers that I mentioned earlier. But next year, 3.9%. 3.9% is fantastic growth for our economy. All things being equal, if I said we're going to grow at 3.9%, you would say, oh, that's wonderful. That is fantastic. So there's still government intervention in these numbers. I don't know that it won't continue for a while, but this is the next slide. This is what they said. We're going to hire more employees, increase our capital investment, we're going to grow our sales, and we're going to benefit from the government. So this is why they feel pretty rosy about next year. But there's obviously risks. COVID-19 is a big one. Labor costs I already mentioned. Supply chain issues if that doesn't ease up. And then a big one for corporations is this discussion about corporate tax rates. And that will have a material impact if taxes go up on corporate America. It's going to go right to the earnings line. And to think about that, like interest rates going up, why we've seen a lot of the tech stocks go down is because the way that we value these companies is based on an interest rate. Same way, if the taxes change, we got an immediate boost when the corporate tax rate dropped. We'll get an immediate hit if taxes go up. So not sustainable forever, but just an immediate fix to get the numbers where they're supposed to be in line with the new reality. This is something that's really interesting that we're already seeing. Number one, Ukraine is probably the headline this week, at least. But this global technology decoupling between U.S. and China, I mentioned that, right? Just separating more and more. Major cyber attacks is another major one. So we've seen a lot of that. I've had clients that have been hit by it in their companies. So, I mean, it's real and it's out there. We've got here on the bottom, Russia invades Ukraine. China attempts to do something in the South China Sea or with Taiwan. So these are things that are interesting, and really Americans haven't been focused on geopolitical issues. I mean, they really haven't. And it's something that makes you a little nervous. Overall, our global BGRI, which is the BlackRock Geopolitical Risk Index, shows a significant reduction in concern about these types of risks since the change in the U.S. administration. The gauge has been hovering in negative territory this year, as the chart shows, meaning investor attention to geopolitical risk is below average for the last 4 years. In the methodology, if you wanted to see it, we've got that. As a result, the shocks could catch investors more off guard than if they were already worried about them. In other words, if we're not worried about anything at all and it hits, it shocks us. If we're already worried about it, we've probably already placed some bets on it. And so I just mentioned that from that standpoint, it is a little nerve-wracking to think about some of the things that are out there. And I think some of the volatility we've seen recently is because of that, not just interest rates and inflation. There's some climate-related risks. That's a big headline issue as well. I'll give you some news. From 1980 to 2020, the United States averaged about 7 events a year with losses exceeding $1 billion. But if you just go to the last 5 years, we've averaged 16 of those events. So the 20-year has it averaged at 7. The last 5 has it 16. And this is weird, but last year, 18 weather and climate disaster events with losses greater than $1 billion in the United States. Pretty crazy to think about that kind of number. But I always love this part of it. Risk brings innovation, right? Why are we investors? We want innovation. We want new stuff. We want to supply the next demand. And so I think that there's a lot of things that are going to come out of the climate change discussion, and a lot of it's going to be innovation, and that's good for investors, right? Whether or not government helps supply some of the fuel for that or not, it's a different debate, but just the fact that there's innovation is pretty neat. One of those that I saw, and I am not kidding when I say this, this is already in the works, right? Already in the works. Isn't that crazy? So, I mean, it's amazing. But not just climate related. How about this one? 3D bone implants. So there are 2 companies that are planning on releasing this technology for commercial use this year. 3D printing in your bone structure. Pretty amazing, right? Virtual reality workouts. But this one's a little weird. Virtual influencers. So everybody knows an influencer, right? Did you know there are, and when I say virtual, these are fake people, right? One is an interstellar traveler who's scheduled to arrive on Earth sometime this year, and she already has a song out on a popular video platform, right? YouTube. So it's pretty amazing, right? I mean, it's kind of crazy what's out there. But what the professionals are saying for this year, and I'll go through a couple of these, just to give you a little bit of back and forth. So this is from Jeremy Grantham. Jeremy founded a company called GMO, Grantham, Mayo, and Osterweiss, and he's always been negative, ever since I've been in the industry. If you ever read his stuff, he's always negative. And not surprising, but in the U.S. history, I would say there is a bigger buy-in this time to the idea that prices never decline, that all you have to do is buy stocks than there has ever been, which suggests that when the decline comes, it will be perhaps bigger than anything we've ever had before. Can't deny that, right? I can't tell you the future. I do say he always says that, though, right? So I hope it's not true this time, but you never know. Next one. This is from the chief fixed income strategist. So these are bond investor fixed income from Schwab. Yields will likely move higher for all maturities. I mean, 2-year, 3-year, 5-year, 10-year. Bonds are going to go up. Yield curve could go through bouts of steepening from time to time, but the long-term trend is likely to be a bear flattener, where yields rise, but the difference between short and long-term narrows. And so what this ends up doing is rates go higher, means we are paid more on the safer investment, like I mentioned before, but the journey's going to be difficult because it's going to get bouncy in bonds. We're probably not going to make that much money in fixed income, but we don't necessarily want to take that money out and go stick it in the stock market either. This is from Goldman Sachs. Although the fastest pace of recovery now lies behind us, we do expect strong global growth in the coming quarters, thanks to continued medical improvements in the COVID, consumption boosts from pent-up savings and inventory rebuilding. And so for 2022, they see GDP actually above the line that I mentioned at 3.9, and they see it pretty positive at 4.5. That's Goldman Sachs. Of course, I mentioned Vanguard's. This is from the head of the Conference Board of Labor Market Institute. While we expect wage growth to slow a little in 2022, in the coming decade, a tight labor market is going to exist. This will largely be due to sizable generation of baby boomers continuing to retire without enough people to replace them in the same spaces. Now again, there are more millennials than there are boomers, but this is the skill gap that we're talking about. And then Schwab, on their economic side, macroeconomic backdrops that include slower growth and tightening monetary policy tend to usher in higher intra-market correlations. That is, the potential for securities to rise and fall in tandem. In other words, it doesn't matter which stocks, all the stocks are going up and down. And I love what it says next. However, we're in no way suggesting that investors should get out of the stock market. Neither getting in nor getting out is an investing strategy. They simply represent gambling on moments of time, whereas investing should always be a disciplined process over time. So I'd like to mention that as well too. In closing, I always like to finish with this. Most importantly, what will 2022 be for you and your life? Your life doesn't function as a byproduct of all this economic and stock market stuff, right? Whatever happens in your life is absolutely nothing to do with whatever Amazon stock price does this year. Right, so I keep focusing on that. Those are the things that you do control, and you can't control this. All we do is look back and see what happened. Or we get scared and we react beforehand and put ourselves in worse situations. So, our goal is always to keep you focused on the long term, on your issues in your life, financial, things happen health-wise. There's a lot of issues that happen in people's lives. And rarely does someone say, wow, if it hadn't been for what the stock market did the last 3 weeks, my life would have been a lot better last year, right? And so take yourself out of that and think about how can you make 2022 as great as you can make it, right? That's what we really want you to do. And we'll be here for you when you need it.
Thank you.
Yeah, I appreciate it.